Not rich yet.
You can take it to like the brink, right? And you can cut everything back and live like an absolute hobbit and be depressed for the next 11 years and then be mortgage free. But that's not really living life, is it? How do you deal with that with clients?
Look,
welcome back to the Not Rich Yet show, where we help everyday Aussies take control of their finances. I'm here with Jace. Jace, thanks for coming in for another episode. I'm really pumped for this one. In this one, we're going to talk about how to pay off your mortgage faster.
it's really important, this one.
It really is more and more important. We've just had rate rises going up. Cost of living is exploding at the moment. It's a really hot topic, and it doesn't matter whether you're listening or watching to this now, a week from when we've recorded it, or in 20 years, that mortgage hanging over your head is going to be something that we need to get rid of.
Definitely.
You've been a broker for yonks, and so you're going to weigh in on a whole bunch of this. Let's start with what some of the preconceptions are or the misunderstandings in terms of paying off your mortgage faster.
Yeah, I mean, a lot of the biggest misconceptions, at least for my previous clients, was interest rate was everything. You know, they always thought, okay, the lower the interest rate, the better off I am. And, you know, in mathematical terms, of course, the lower interest rate is always welcomed for everybody.
Yeah.
But it's what you do around with that interest rate and how you structure your mortgage is what's really important and what really saves you the money long term.
Awesome. So in this episode, we're going to run through some really simple strategies, maybe some slightly more complex strategies on how to pay off that mortgage faster. We're going to talk about some small changes that people can make that can save them a bunch of interest, because that's really the aim of the game, right? Get the total interest that we pay down as low as possible. And then we're going to talk about a simple mindset shift that needs to change so that we can move forward and get rid of that mortgage hanging over our head, because at the end of the day, we just want to be mortgage free, right?
Definitely.
Before we get into that, we were talking just before, and we were, just vibing back and forth about your name and Jason Derulo. One of the guys asked if you've met Jason Derulo before. So do all of you Jasons just get together and have like
We have a
catch-up?
secret meeting, it's the Jason Club.
Yeah.
Yes.
Okay, so you've met him?
Yeah, I have. So
Yeah.
actually, funny story is, like,
Yeah.
I used to be a dealer at the casino, and he was on my table for a tour of his, and he was obviously at the Star Casino at the time, and he was dealing, and he was wearing a hat for privacy reasons, and my supervisor at the time, who would have been in his mid-60s, white guy, doesn't know who Jason Derulo is, going, "Hey mate, can you please take your hat off? You're not allowed to wear hats on the floor." And Jason Derulo's security was like, "Oh, he just needs to wear it for privacy concerns, just in case people bombard him."
Yeah.
And then my supervisor goes, "I don't care. I don't give a fuck who he is. Like, he has to listen to my rules. He's at my table." And luckily, Jason Derulo is a nice gentleman, and he just took his hat off and obliged by the rules, and it was all fun and games after that.
Did he like sign a chip for you or sing a song or anything like that?
There's nothing like that.
Is he a big tipper?
We're not allowed to take tips at the casino in Australia, at least. So,
Okay.
So no. So don't know if he's a big tipper or not.
Did he win?
He didn't.
Okay.
He didn't. But he didn't play that big
Okay.
as well. So
Yeah. I wonder if he's got a mortgage. Anyway, that's got nothing to do with what we're talking about, but I thought it was just fun anyway. Tell us about a story that you've heard or something that stands out when it comes to paying off a mortgage fast. We know that hangs over our head for 30 years if we actually stick to the repayments and don't refinance all the time. Talk to me about something like that you've seen in your experience.
yeah, I mean, I've had clients who I've got mortgages with, who they refinance with me, and they as a couple, as a combined income, they made quite a lot of money, and they had a very healthy surplus every week after paying off all the expenses and their mortgages expenses as well. The gentleman in that couple was really into shoes and sneakers, and it wasn't like normal shoes where it's $200-300. They were like more exclusive sneakers, and he tried to find rare finds where they were like $2,000 to $3,000, could be $5,000. Really depends on the sneaker.
So he's like collecting them.
Kind of collecting them in a way.
Was he wearing them?
I don't think so, no. So I think he'd more of like collection of it.
Because you see those people who've got like massive walls of shoes, and then for 30 years, they don't wear them.
Yeah.
And then because they haven't worn them and there's no pressure in them, all the rubber and everything breaks down. And
Exactly.
all that
Yeah.
sort
So he
of
doesn't.
stuff.
I don't think he like wears them or anything like that.
I wanted to buy a pair of Back to the Future shoes, those
yeah.
ones, and they're like, I don't know, 60 grand or 70 grand or
something
whatever.
crazy, yeah.
But now, because they've been out for so long, there's that risk of they start disintegrating. So I'm just going to buy some dupes or something for
Yeah,
you know,
you might as
$1,000
well. It's
or
probably
something
better
like
off.
that.
It's probably better
and then
off.
I'll come in to one of the episodes dressed as Marty McFly. So then that can be a full tax write-off.
That could be,
no,
yeah.
not tax advice, but yeah. Okay, yeah.
But anyways, like, yeah, with these shoes, obviously, or with any big purchases, I told the client, you know, like every time you make a big purchase that's outside of your kind of budget zone and everything like that, it does cost you more than the actual cost of the shoe over time, over your mortgage. And then he's like, what do you mean by that? He's like, well, if I put this in a simple calculator, your $3,000 shoe can actually cost you $13,000 on your mortgage if you, instead of putting that inside your mortgage instead. And he was just a bit mind blown and is kind of set aback from that. And we kind of looked over his budget again and kind of made sure he can afford putting extra into his mortgage to save kind of years off his mortgage, which was really important to him and his wife, but also have, you know, still have enough money to be able to buy things that he wants to collect himself personally, just on a smaller scale. So
Yeah, I think that's the point, right? Because if it's, you can live like a hobbit and then put stuff into a calculator. We've got a calculator online. They'll put the link around somewhere. There might even be like a ding noise that comes up when the link pops up. So you can go there, punch your numbers in and see if I add an extra $100 a month or $3,000 in a lump sum, how much that cuts off and how much that costs us. But you can take it to like the brink, right? And you can cut everything back and live like an absolute hobbit and be depressed for the next 11 years and then be mortgage free. But that's not really living life, is it?
No.
How do you deal with that with clients?
Look, it happens a lot. And I was actually speaking to my partner about this, and she, you know, in her early 20s, it was a savings era where she was saving throughout all her early 20s, trying to buy this house for the first time. And she realized it's kind of like almost like a sad moment where you save all this money, you buy your first house, but then now you're in your paying off a mortgage era, and it's not living your life or enjoying your life anymore. And she's basically in her late 20s, early 30s now. So I guess it's more so of managing expectations of you don't have to live on ramen noodles every day just to pay off something financially. You can have a balanced lifestyle as long as you budget well and understand what parameters you can be within that.
Yeah, because you can, like anything, you can go aggressive one way or the other. And I always put it to like, you know, trying to lose weight. It's like you can go and do the lemon detox diet for 7 days and then put it all back on the Sunday because you're so famished, or you can actually do it sustainably. Yeah. That what you were talking about just then reminded me of a story when my wife and I got our first mortgage. We were 23, 24, something like that, moved straight out of home into the house. And about 3 months beforehand, we knew that this was happening. You know, we put the deposit down, things were sort of settling and moving into place. We hadn't actually settled yet. And in that 3 months, the amount of spending that we did, that we were justified by, oh, well, once we've got the mortgage, we won't be able to have this money. So honestly, I can't remember how much the mortgage was, but let's just say it's like $4,000 a month, right? And we were spending over and above that on the 3 months tour. I remember we went to this Coldplay concert, stayed there overnight. The amount of spending that we justified on, oh, well, we're not going to have that money then. And now looking back, I was like, okay, that was a whole bunch of fun. That was amazing. And I think it was great. But that's on the other end of the pendulum as well. I think it swung too far with that. And I think back and I'm like, okay, well, let's just say it was $4 or $5 grand a month for those 3 months leading up to that. If I had that 15 grand and had slapped it onto the mortgage, I haven't put it through the calculator and I don't think I'm going to because I'll be depressed. But that would have made a huge difference. So I suppose why we're sharing all of this stuff is that this has come from experience, our own experience, mistakes that we've made that we need to, you know, tell other people about so that they don't make the same mistakes. And one of the big ones is just assuming that you have time. Yeah. And so I was talking to somebody the other day and they were in their, you know, mid 40s and they were saying how, you know, one of their partner's a procrastinator. And so they've been trying to get their partner to take action for like the last 15 years. And now they're finally ready to do something about it. And I didn't talk to them about what would have happened if they did things sooner because you don't have a time machine, so you can't go backwards. But everyone who's listening and watching this, listening to this and watching this, needs to understand that the day that they let go by without taking action is another day that the bank makes more money, but also is another day that they can't get back. Because if they want to retire by 60, 70 or 80 by the looks of their actions at the moment, they actually need to do things more aggressively and faster sooner, because they don't have as much time for the things to grow. Like when we're talking to 20-year-olds, the advice to 20-year-olds is different to the advice to 50-year-olds, completely different. Anyway, I completely interrupted your story. So go back. So you're talking to this guy spending a whole bunch of money on shoes. You showed him how much the difference is with that. What was the sort of takeaway with it? Where did that end up?
Yeah, so that mortgage was that mortgage client was like over 5 years ago now, and I guess since then, kind of having that plan and putting that in place, he's now projected to pay off his mortgage basically in 3 more years. Where originally he got it for a 30-year mortgage, so he would have been paying it off in 8 years projectedly, basically, because they have the means to do so. But because they tweaked a little bit of their lifestyle where they gave something up a little bit, but to also gain something else on the other end financially.
Was it just the shoes? Like what were the other stuff that
it was
sort of
more
going
sort of like a very high life spending habit of it wasn't just shoes, but it was things around that cost $2,000 to $3,000, or very expensive dinners, or going to hotels for no reason on a random Saturday night because they have the spare money to do so, and they really did. But it was just more sort of shifting priorities of what they wanted to do, and they're almost going to be mortgage free, and they're going to be in their mid 40s. So
yeah, so that's awesome. I think that's an awesome outcome. So I think the key, I won't say takeaway, but thing to note with that is it's a common behavior pattern when you've got people who are earning good money, and good is is not defined by a number. It's not 200 grand or $1 million or whatever. But if you've got enough money to be comfortable, then you will always be comfortable. And so when you mismanage that cash that's coming in, and when I say mismanage, I mean you don't put it towards the things that you want to achieve, and you just look at your bank account, we've got enough money, we'll spend it because I want to, then there's that real mismatch between you're sacrificing future you to prioritize current you right now and what you want to do this weekend. So I think it was good for that couple that you're talking about to acknowledge that now was the time, and to be ready to reallocate those, reallocate that cash, because the proof's in the pudding. And now they've got the whole mortgage payment that they can play with in such a short span of time. It's amazing. So what I want to do now is talk specifically on people who are watching this and who are listening to this, who've got a mortgage, and what they need to do to actually pay it down faster. So I've got a couple of steps that people need to go through. So the first one is, if you want to pay your mortgage off faster, you've got to make sure that your mortgage is actually the right structure that you can pay that down faster. So talk to people about the right structure. I'm not talking about offset accounts or all of that sort of stuff, but the actual right loan to be able to pay it off faster.
Yeah, look, obviously to have the flexibility to put extra money into the mortgage to actually lower that principal down to a point, is it has to be a variable rate. It can't be fixed, and if it is fixed, there is a limit to how much you can pay extra per year. So I would check whoever your bank is with, check how much extra per year you can pay into that. Not everybody knows, if you have a fixed rate, you can actually pay extra still into the mortgage, but there is a limit to that. So variable is obviously, there's no limits to how much you can pay extra, and that's really important too.
And so on that point, as interest rates move left, right, up and down, even they stay the same, the biggest question that we get is, should we fix it? Should it be variable? But it doesn't have to be one or the other, does it?
No.
Like you can split the loan in half almost, or by any percentage. Talk about that.
Yeah, I mean, there's not one size fits all in terms of, if you're at home listening, should you fix your mortgage? Should you keep it variable? It doesn't have there's not one answer that fits all. But there is options for you. So if you feel like you can make a little bit extra repayments, but you still want that certainty of a fixed rate, knowing that I can pay exactly this much, you can fix a portion of your loan. If you have a $500,000 loan, you can actually put $100,000 aside and make that fixed, guaranteed. The other $400,000 would be variable, and you can pay extra into that and try to pay that down and lower the interest rate for that.
Awesome. So I suppose that's the first point. Make sure that you've got the right loan that can actually be paid down. If you need help assessing that, you can reach out to us, or we can get people on our team of brokers in our partner network to help you out with that. Second thing is that people need to maximize. The second thing is that people need to maximize the gap between what they're earning and what they're spending. So the very simple maths on this is if you're earning $2,000 a week and you're spending $1,950 a week, the maximum that you've got to pay down your mortgage faster is $50 a week. So there's only two levers with that. Either earn more or spend less. We always tell people to spend less first because you don't have to worry about tax. Every single dollar that you save is a dollar that's in your pocket. Now, I know that there's a bottom on that because life is expensive and life costs money, right?
For sure.
A Netflix subscription costs the same amount regardless of how much money you earn.
Yep.
But do you need 14 subscriptions?
Exactly.
I was talking to somebody yesterday and they said to me, have you watched this show? And I was like, I don't know if I have that subscription. And they're like, you don't have every one of them? I'm like, no, I don't have every one of them. Why do I need every one of them? I can only watch one show at a time.
Yep.
So I think my point is that there's a bottom to that. But most people that we speak to aren't anywhere near the bottom. They think they are, but they're not. And so if people need help in building that gap between how much they're earning and how much they're spending, then that's the perfect place for us to enter the conversation, do some calculations with them and show them how they can save more money and how they can better use the income that they have to pay down their mortgage faster or even reach their goals faster without actually going and earning more. There's a whole bunch of other episodes that we've got that are coming up that will talk about that.
Just the other day, I was just renewing my car insurance annually, and I've been with the same insurer for my car for like the last 3 years, and it just auto renews, and I just never think about it. And I got an email for it the other day, and I was like, oh, it's up for renewal. And I was like, I don't remember paying this much. So I looked at my emails 3 years ago. It was $400 more expensive than originally it was 3 years ago. And so I just did a simple shop, looked online to see anything cheaper, and I got it for about $300 cheaper. So I saved myself $300 without blinking an eye. Like,
exactly.
It's crazy, yeah.
And, my wife drives an electric car, and the renewal was up the other day as well. And she said to me, can you believe this? And she went around and did the whole shop around. And the insurer that she found that was cheaper was $400 cheaper a year or $500 cheaper a year. But the agreed value they reduced down by like 15 grand on the car. And then the insurer that we were currently with, the price went up by $1,500 throughout the year. And so anyway, she found one that was exactly the same, best value, all of that sort of stuff. And simply by doing that, and to be fair, it was probably a ball ache for her. I wasn't there. I didn't have any involvement in it at all. Probably took her a couple of hours to do. But if that saves you $1,000, think about, do you get paid $1,000 in 2 hours?
No.
That's after tax?
Yeah.
I doubt a lot of people get paid that.
Exactly.
So it's definitely worth it. So that's point 3. So just to summarize, that's point 2. So just to summarize, you need a system to create the gap between income and expenses and have that as high as possible. If you need help with that, we're definitely here to help that. All right. Point 3 is that you need to get that cash that you create with that gap. So your savings, you need to get that cash sitting on the mortgage. You can put that into an offset account. You can put that into a redraw account. But you need to have the right structure of that and the right amount of accounts to make sure that it's saving you money on interest, but also so that you don't think that you can just go and take that money for anything that comes up.
Exactly.
Because as humans, we're conditioned in our brain to use all of the available resources to us. And that's why people who want to lose weight have smaller plates, because they're filling in all the gaps still. And if you've got a bigger plate, then you'll fill in that gap.
Yep.
So if you've got a whole bunch of cash, 100 grand, 200 grand, 300 grand sitting in an offset account, and you're like, I really want to go on that holiday to Hawaii, it's going to cost 20 grand, I will just dip into that. You need to make sure that those are set up in the right buckets and structure and envelopes so that you don't feel like you can just steal from that.
Exactly.
Any comments on that point?
Yeah, definitely. I mean, I sometimes with clients that have like just a one offset account that have money put aside specifically to save money for the mortgage, I tell them, every time you take it out, you're basically using a credit card because you lose interest every time you take money out of the account because you already put money in there.
Yeah.
So it's basically you're basically using a credit card at that point. They're like, but it's my money. I'm like, I understand it's your money, but now it's just your money to pay off the mortgage.
Yeah.
So if you every time you use it, you're paying them back the 6% interest rate that you're paying
Exactly
them.
right.
So
Exactly
yeah,
right.
it's a bit of a shocker.
And banks love that
They love
option
it.
because it's free money to them
Yeah.
in terms of they're just lending you back money that you've already given them.
Yeah.
So they love that. And just like, before when we were talking about with shoes and all of that sort of thing, if you have access to it and you can justify that, then you're just going to do. Yeah, exactly.
And the banks love, like, offset account seems like it's what the banks are using as a tool to help you guys, to help the consumer going, you can save so much money if you put so much money in the offset account. But they're much smarter than people think, where they know that people have a tendency and psychologically, like in a psychological matter, that if they have the money there, they're going to spend it. And it's going to be very easy for them to access that.
I don't believe, and I'm not bank bashing, right?
Yeah.
But I don't believe that the banks are doing that to help us.
No.
In what world would a business specifically create a product so that they could make less money?
Exactly. I mean, it's like where Macca's would sell, back in the day, 15 cents ice cream cones to come into the door, but you're going to be buying the Big Mac meal with the large fries and large Coke.
Yeah.
With the bigger margin. So it's a strategy to that.
Definitely. Okay, so then number 4 is you can use one of our calculators to see at the rate that you're saving. So let's just say it's $200 a week, and putting that onto the mortgage. At the rate that you're saving, how long is that actually going to take you to pay off the mortgage? So let's just say you've got a 30-year mortgage and you make extra repayments into that at $200 a week, and that saves you 5 years off the mortgage. So you've got 25 years left. Why you should be using one of our calculators is that then tells you, are you happy with that or not? Because some people are happy with 25 years and to save 5. Some people want to do it in 7. Some people want to do it in 3. And so the sense check or the temperature check is use one of the calculators and see whether or not
Know exactly
you're happy
what's
with
affordable.
that.
Yeah.
Yeah. So then the 5th step is that if you're not happy with that and you can't increase the rate of your savings, so if you've maximized the amount of income that you can get and you've cut back on the expenses to the level in which you don't want to do anymore, then you have to rocket fuel that savings rate or the ability to pay off that debt and consider investments to do that. So I'm not advocating for property investment. I just want to use this as an example. And the caveat is that this is not financial advice. Anyone who's listening to this, it's rare that I probably met you. I don't know any of your circumstances. I just want to talk about this in general terms. So if you've got somebody who's got 200 grand that's sitting in their offset account, and let's just say that their mortgage is $1 million. So they're getting charged interest on $800,000. If that person is saving $200 a week, it means that the offset account is building by 10 grand a year.
Yep.
So at that rate, and by paying the minimum repayments, it's unlikely that they're going to get their mortgage paid off as fast as what they want to. One of the strategies that we're seeing people use is take half of that money from the offset account, so call it $100,000. They use that as a deposit on an investment property, as a 20% deposit on an investment property. So that means that they can buy a $500,000 property. If that property is bought in the right area and matches their risk profile and means that they don't have to tip too much cash into it and a whole bunch of other caveats, if you assume that that grows at 10% per annum, that's 50 grand a year compounding each year that they're getting in capital growth on that property. That person has now gone from saving $10,000 a year to now creating an upside of 60 grand a year.
Yep.
And that means that accelerates the years far, far faster.
Exactly.
Now, it's a whole strategy that needs to be required and built it out. You need advice from a whole bunch of different people to make sure that you do it right. I've seen so many people get it wrong.
Doing it wrong. Yeah.
I was speaking to my mate the other day and he said, I want to buy around the corner from my current house. And I'm like, why? And he said, because then I can keep an eye on it. But if you look at that scenario, it's like, well, is that actually the right investment for you? Because you're going to have to tip in $900 a week into that to get growth of, maybe $1,000 a week. So it's not something you can take lightly and just go shoot from the hip and go and do. You need guidance to go and do it.
Yeah.
But that's the 5th step, is to consider that, using investments to accelerate the rapid rate that you can pay down your loan. Comments, thoughts, questions on that?
Yeah, look, I guess we've had clients who've had really bad investment advice come to us previously in the past, and me and you have dealt with those clients before, where they've listened to certain groups out there, and have really, like, I guess fucked them over, really. Like, she's not in a good place in terms of financially, and we're helping to try to build that back up and her confidence back up around that.
Yeah.
So it's really do your own research as well, as not just listen to Joe Smo around the street saying that you should buy this property. It's really understanding what will you get out of it, and what's the potential of it. And
yeah, and one of the things I was thinking about that we could do in a future episode is talk about who are all of the people that are providing advice in the market, and what their sort of role is in that. So, like an accountant, broker, that sort of stuff. So I think we'll do that on future episodes. That's a really good one. And we'll make sure that somehow we link this one to the other one. Yeah. But that'll be, watch this space and we'll get to that. So I suppose in summary, if we had to sort of talk about takeaways, what's your perspective in what people should be doing from here to the next step?
Yeah, I mean, for me, in terms of the key takeaways of what we spoke about in this episode, is like my biggest one is, and the easiest one to kind of fix straight away, is manage your spending. If you can manage that, you can do that from day one. You don't have to find a better job, more pay. You don't have to change any structures in your mortgage or anything like that just yet. The fastest and the easiest thing and the biggest difference is, if you can change your structures and your spending from day one, then everything else can kind of be aligned in place.
Yeah, and I think that's the perfect takeaway. I think the second step is to then think about, once you've created more of that gap, then make sure that you've got the right mortgage structure in place. Make sure that is sitting in the offset account or the redraw, and that you're happy with the rate in which you're paying that down. And if you're not, then you should seek some advice to consider some investments with that.
For sure.
Yeah. All right. Awesome. I think this has been a great app. Thanks again, Jace, for coming.
It's been an awesome one.
One thing just on the tag on the end, if anyone's listening to this or watching this and they want some help, we're really nice guys. So just reach out to us, and we're more than happy to have a chat and a chinwag, just to even steer you in the right direction, whether we can help or we just point you onto somebody else. We want to help as many people as possible in this situation and in this economy. I mean, if also, just as a side note, if your name is Jason, you want to join part of the Jason Club and you're not in that, just let me know. And Jason Derulo's. Yeah. Jason Derulo's the head of that. So if you want to meet him, just hit us up. Yeah, just over there in the corner. Jason's only though. So Jason's only. Yeah. All right. Awesome. Thanks, Jace. Have a good one. Okay.